investing in playing basketball is very similar. When it comes to investing, the rule is very simple. You buy low, sell high. But many different investors have different strategies around how to achieve that same goal. When it comes to basketball, everybody knows you get the ball inside the hoop. That's it, right? But there are so many different play styles, just like investing. Now, in this particular case, I want to share with you my own strategy, how I invest in the investing stock market, right? Because the way I invest may be very different from how some of you guys invest. The very first thing that I do look into is the company growing? All right, the company in its overall revenue has to be growing. Now, in terms of overall net income, sometimes companies can have higher expenses. That's fine with me. But as long as the overall revenue, the overall money that they get from customers, that is growing at high levels, I typically like to invest in growth companies. And those are what we consider growth companies, companies that are growing their revenue at a higher rate. And because they grow their revenues at a higher rate, sometimes they are trading at a higher multiple, higher price to earnings ratio. That, to me, a higher PE ratio is not something to stop me from investing. However, that is one of the key components. The second thing that I look for is this a company that can make money during a good economy and a bad economy? Because there are so many companies that can make money during a good economy, but when it comes to a bad economy, we have some sort of issues here, right? For example, when you take a look at airline companies, during good economies, people are spending, people are traveling, it's going great, their earnings is going higher. But during a bad economy, when we have a recession, one of the easiest expenses for consumers to cut is actually vacations. One of the easiest expenses for businesses to cut during a bad economy is, hey, let's just cut down on business class, first class tickets, and now you're going to be flying economy. And this type of business model where the stock is going higher, but during a recession, they get a huge dip. That is something I am not a big fan of. Another type of company that does that is the cruise lines. Cruise lines, during good economies, they're doing great. During bad economies, people like to cut down their spending on cruise lines. I need companies that when I am investing in them, they can make money during good economies and during bad economies. It's one of the main reasons why I have 3 stocks as a core position, which is Microsoft, Google, and Costco. I believe all 3 of them, even during good economies and during bad economies, they'll be able to grow their earnings at significant amounts. Now, the third thing that I do look for when I am investing is the moat of a company. And the best way I can kind of describe a moat to you is how easy is it for another company to go ahead and replicate the business model, because I need the companies that I invest in to be so hard for them to be replicated that they're the only ones, that they in itself essentially create a monopoly in their field. When I take a look at Microsoft, it's pretty darn hard to replicate the business model of Microsoft. When I take a look at Google, it's pretty darn hard to replicate the business model of Google. There's so many people that have tried, they were not able to do it. Same with Costco. People try to go ahead and replicate business model of Costco. Nobody can do it as well as Costco. Now, those 3 are my main 3 things for when I am investing. Sometimes though, I do have different criteria on what I am investing. For example, is a company going down based on a particular narrative? If that is the case, I am buying a ton of it. For example, when I take a look at the recent narrative of SaaSpocalypse, where a ton of SaaS companies were just going down. It didn't matter if their earnings was going great or not. The company stock price kept on going lower. Those for me are amazing buying opportunities, because when I take a look at the earnings that are going higher, but the stock price is going down, I always have this belief, at least this hypothesis, that at one point or another, the stock price of a company will follow the cash flows of the company, will follow the profitability of that company. And this is one of the reasons why I've been able to make so much money on Google stock back in 2015, where you looked at their earnings, it was doing great, yet the stock price was lagging behind. Same thing with Microsoft in 2026, where stock price is lagging behind. But when I look at the earnings of Microsoft, I am incredibly impressed. Whenever I see a massive sell-off based on macroeconomics data, those are the type of buying opportunities I like to include in my stock purchases. It's funny, when I first started investing in the stock market, the very first question I started asking myself as a beginner was, can the stock that I'm looking at right now, can it make more money in 2027, 2028 compared to, keyword there, compared to 2026? Because if the answer to that question was a resounding yes, if I was very confident in that answer, the chances are I would go ahead and buy more of that company. When it came to Microsoft, for example, in my head I think about, can I see Microsoft making more money in 2027, 2028, 2029 compared to 2026? The answer, although it's not 100%, nothing can be 100%, I was very confident in my answer that this is a company that would increase their earnings time after time after time. Same when it comes to Costco stock, same when it comes to Google stock. One of the main reasons behind that is because their moat is so strong that it almost makes them kind of like a secret monopoly, where they're just able to increase, beat and raise their earnings time after time. Now, these are not the type of companies that are gonna surprise you and wow you like the Microns of the world or the Sandys of the world, but I like that type of predictability in my stock picks, where I needed companies that don't need to go 100% up a year, but I am happy if they went up by 15 to 20% year over year. That type of compounding was what I was looking for in my stock picks. And it's one of the reasons why I continue to have them as my core positions. Now, besides my core positions, sometimes I do have my, what I consider, other bets. For example, I have Nvidia and Robinhood there. Now, these two companies are a little bit more volatile than the other Mag 7 companies that I bought into, yet I have this vision for them in the future that I'm willing to make a bet that their earnings is going to be a lot higher. A lot more people are going to utilize their products in the future compared to 2026. And it's one of the reasons why, for those two particular companies, I believe that they could make money. Um, it's one of the reasons why, for those two particular companies, I believe that they would make more money in 2027, 2028 compared to their 2026 self. And as a result, I wanted to start a small position into them. There are absolutely a lot more reasons for why we would purchase into particular companies. But for me, in my type of investing, these are the reasons for why I invest the way I invest in. I need companies that are growing their revenue, that are growing overall. I need companies that can make money during a good economy and a bad economy. That is very, very important to me. I need companies that have a strong moat, moats that are so strong that they're almost a monopoly. And I need companies that I believe can make more money in 2027, 2028 compared to 2026.